Welcome to Invert That. In today's video, we're going to explore one of Charlie Munger and Warren Buffett's most powerful ideas, incentives. The purpose of this video is to understand how incentives shape behavior in business, investing, management, compensation, accounting, Wall Street, and human decision-making, and why Munger often emphasized that incentives are one of the most important forces in the world.
It really is it's the core of everything they do.
It is. And to start this deep dive, I want you to imagine this scenario. Let's say you're the CEO of a major public company, and for 10 straight years, your underlying business just completely stagnates.
Like zero actual growth.
Zero. Not a single new customer. Margins stay completely flat. Yet at the end of that decade, you legally walk away with $158 million of your shareholders' money.
Which just sounds illegal when you say it out loud.
Right. But today, we are going to look at the hidden math of Wall Street to show you exactly how that happens, and more importantly, how you can spot these invisible forces driving that kind of behavior.
And we've got a lot of ground to cover to do that.
We do. We're pulling from a massive stack of primary source material today. We're looking at Berkshire Hathaway annual meeting transcripts from 1994 all the way through 2022.
Which is just a goldmine.
Oh, absolutely. Plus, we're diving into Warren Buffett's legendary shareholder letters, his early partnership letters, and those incredibly detailed Wesco financial letters written by Charlie Munger between 1995 and 2009.
Yeah, those Wesco letters are dense, but they are so revealing.
So the goal is to synthesize all of this so you can start seeing the world in human behavior the way these two legendary capital allocators see it.
And what really stands out immediately when you go through these thousands of pages is that for Buffett and Munger, analyzing a business is rarely about, just building complex spreadsheets right out of the gate.
Right, which is the exact opposite of what you learn in finance class.
Exactly. We're taught that valuation is all about discounted cash flows, right? You build a model projecting how much cash a business will generate over the next 10 or 20 years, and then you discount it back.
It sounds so precise.
It does. It sounds incredibly scientific. But the letters and transcripts constantly remind us that those cash flow projections are entirely created by human beings.
Right.
And if you want to understand what a human being is going to actually type into that spreadsheet or, what acquisition they're going to make, you cannot just look at the math.
You have to look at the psychology.
Yes, you have to follow the reward structure. They view incentives not just as some mechanical business tool, but as the fundamental engine of human behavior.
I really want to unpack that.
Yeah.
Because to understand how they spot bad businesses, we first have to understand why they view incentives as that ultimate driver.
Yeah.
There's this brilliant moment in the 1994 Berkshire Hathaway annual meeting transcript. They're fielding a question about management compensation, and Buffett uses this simple analogy to just cut right through the corporate jargon.
Oh, I love this one.
It's so good. He says, if you want a typist to type 100 words a minute, you pay for typing 100 words a minute, not what the overall company's earnings per share were last year.
It almost sounds laughably simple when you say it out loud like that.
Yeah, it's common sense.
But if you evaluate corporate America through that exact lens, you realize how radical a departure it is from the norm.
Right.
Throughout the Berkshire annual meetings, especially around the late 90s and early 2000s, they constantly point out this recurring flaw.
Yeah.
You just cannot disconnect a person's behavior from the specific metric that dictates their reward.
So if a manager's bonus, or even just their prestige at the local country club, is tied to the total size of their company, like total revenue or total assets, what's going to happen?
Well, they are going to build an empire. They will try to become as massive as possible, as quickly as possible. That is the guaranteed outcome.
Yeah, they'll just go out and blindly acquire other companies just to get bigger.
And the tragedy for you, the everyday investor, is that they will do this even if it completely destroys the per-share value of the business for the actual owners.
Can you break down how that actually looks? Because in the shareholder letters, Buffett gives a really vivid description of this dynamic.
Yeah, it's a great example. So imagine a CEO who desperately wants to buy a competitor just to increase the total size of their empire.
Okay.
Let's say the target company is intrinsically worth $100 a share. However, the CEO's own company stock is currently undervalued by the market, trading at only $80 a share.
Right, so their currency is weak.
Exactly. So to make the acquisition happen, the CEO might offer, say, 1.25 shares of their own stock to buy 1 share of the target.
And they'll go to their board and say, look, we negotiated a fair deal. We're paying $100 per share.
Right, but they are willfully ignoring the underlying math. Because their own stock is fundamentally undervalued, they are actually giving away $125 of intrinsic value just to get $100 in return.
Wow. So mechanically, for the listener who might hold stock in that company, it means this mismatched incentive structure is mathematically diluting your ownership.
Absolutely. The CEO isn't necessarily waking up thinking, how do I destroy shareholder value today?
They're just following the gravity of their incentive structure.
Exactly. If their paycheck gets bigger when the total revenue number gets bigger, they will issue as many new shares as it takes to buy that revenue.
Even if your slice of the pie gets smaller and smaller.
Yeah. And this natural human tendency to bend reality to fit the reward structure is so powerful that Charlie Munger coined a specific term for it.
Incentive cause bias.
That's the one. It's a huge part of their mental models.
Which is a perfect segue, because I want to look closely at how Munger actually dealt with this phenomenon in practice. Let's look at those Wesco Financial Corporation letters from 1995 to 1998.
Yeah, for some context for the listener, Wesco was a partially owned subsidiary of Berkshire Hathaway, and Charlie Munger was the chairman.
Right, and during this period, he was writing these incredibly dense, transparent letters explaining Wesco's entry into the supercat reinsurance business.
Right, and supercat stands for super catastrophe.
Sounds intense.
It is. We are talking about insuring against the absolute worst-case scenarios imaginable, like a hurricane significantly worse than Andrew, or a devastating earthquake hitting a major city.
And Munger explained that Wesco had this subsidiary called Wesco, right?
Yes, and Wesco maintained a massive net worth compared to the premiums it actually earned. Munger described it as having a Fort Knox balance sheet.
Which you'd need for earthquakes.
Exactly. In the reinsurance world, that is rationally required if you're going to be a standalone insurer for these massive, unpredictable risks. You have to be prepared to occasionally pay out many times more in a single year than you take in.
But the really interesting operational detail, which he brings up in the 1998 Wesco letter, is that Westlake wasn't out there sourcing these complex insurance deals themselves.
Right. They were getting what are called retrocessions, which is basically insurance for insurance companies.
So they were buying slices of risk from National Indemnity, which is a wholly owned subsidiary of Berkshire Hathaway out in Omaha, run by Ajit Jain.
Yeah, and Munger details the exact mechanics of how these retrocessions were structured. He set up this automatic acceptance system.
Meaning Westside would automatically take on the risk that Omaha sent them, but with incredibly rigid conditions.
Extremely rigid. Westlake would only accept the risk if two things were true. First, Westlake could take 20% or less of the total risk.
Okay, and the second?
Second, and this is the crucial part, the wholly owned Berkshire subsidiaries back in Omaha had to retain at least 80% of the exact same risk on their own books.
So this structure raises a really vital question about human behavior. Why did Munger insist on this strict 80-20 rule? Why demand that Omaha keep 80% of the downside?
Well, the answer goes straight to the heart of avoiding incentive-caused bias. Munger wanted to be absolutely certain that the executives making the original highly complex underwriting decisions were, in his famous phrasing, eating their own cooking.
I love that phrase.
It perfectly captures it. If the executives evaluating a multi-billion-dollar earthquake risk are holding 80% of the potential catastrophic loss on their own balance sheet, their incentive to price that risk accurately is ironclad.
Because if they price it poorly, they aren't just passing a toxic policy off to some subsidiary. They would be blowing a massive hole in their own capital.
Precisely. And in the letters, Munger explicitly contrasted this Berkshire method with standard Wall Street practices.
Right. He warned his shareholders about the danger of competing sellers in the reinsurance market, who are simply looking for what he called a liberal intermediary profit.
Yeah, these are brokers who try to place a massive complex risk with a layoff reinsurer. They take a hefty fee for setting up the deal, but they retain 0% of the major risk themselves.
None of the downside.
Exactly. And Munger noted that it is incredibly hard to find a reinsurer who is smart enough to actually pay out the eventual losses, but casual enough about their own costs to let an intermediary walk away with a massive risk-free profit on day one.
I need to push back here, though. Let me play devil's advocate for a second.
Go for it.
Let's think about this from the perspective of the broader financial market. Aren't investment bankers, insurance brokers, and these various intermediaries legally or at least professionally fiduciaries?
That's the assumption, sure.
Doesn't their professional reputation and, their desire to stay in business long term prevent them from just shoving bad deals onto their clients?
It is a totally logical assumption. I mean, it's what they teach in business school.
Right.
But the Berkshire annual meeting transcripts systematically dismantle that assumption. The counter-argument Munger and Buffett present is that this isn't about conscious malice.
It's not some cartoonish villainy where a broker is rubbing their hands together trying to scam a client.
No, exactly. It is purely about the subconscious math of the incentive. In the transcripts, they point out a very simple equation. An investment banker gets paid 20x if a deal closes, and they get paid X, or sometimes 0 if it doesn't.
Wow, 20x versus 0.
Right. And when the reward is structured with that kind of extreme asymmetry, the human brain is incredibly skilled at subconsciously finding a way to justify why the deal is actually brilliant.
It's that incentive cause bias again?
Exactly. Munger uses a famous heuristic to summarize this. You should never ask a barber if you need a haircut.
And by extension, you shouldn't ask an investment banker to evaluate a business you want to buy.
That is the direct application. If a CEO feels insecure about their capital allocation skills and hires a high-priced investment bank to advise them on a potential merger, the advice is almost inevitably going to be, do the deal.
Because the intermediary is completely shielded from the long-term operational risk of the acquisition.
Yep. But they are heavily rewarded for the immediate transaction. In one of the Wesco letters, Munger mentioned that these financial professionals are selected in this fierce Darwinian process to have formidable sales skills, high intelligence, and immense energy.
And when you combine those traits with an incentive structure that rewards transactions over long-term value creation,
you get incentive-caused bias on a systemic, market-wide scale.
that really reframes things completely.
Yeah.
It's not that the intermediary is waking up thinking, how do I trick someone today? It's that their perception of reality is distorted by the massive paycheck waiting at the closing table.
They genuinely convince themselves the terrible deal is a great idea.
Okay, so we've talked about how to stop bad behavior when you are buying companies.
Yeah.
But what about the people actually running them?
That's where it gets even crazier.
Yeah, because if Wall Street's transaction-based compensation models are broken, the sources suggest executive compensation in corporate America might be even worse.
Oh, without a doubt.
Let's dig into how Buffett views management pay, specifically standard fixed-price stock options.
If we look closely at the shareholder letters from the early 2000s, there is a blistering, sustained critique of fixed-price stock options.
He does not hold back.
Not at all. He frequently describes them as a free lottery ticket for management. And to understand why he hates them so much, we have to look at the mechanics of corporate finance.
Right.
The fundamental flaw with standard stock options, as outlined in these letters, is that they do not account for retained earnings.
Okay, let's pause here and make sure we clearly define retained earnings for the listener, because it is the absolute cornerstone of understanding why standard stock options are so heavily criticized in these letters.
Good idea.
When a company makes a profit, say they earn $100 million in a year, they have a choice. They can either pay that cash out to the shareholders as a dividend, or they can retain those earnings.
Meaning keeping the cash inside the company to build new factories, hire people, or buy back stock.
Exactly. The cash they keep is the retained earnings.
And this is where the legendary example from Buffett's shareholder letters comes into play. To illustrate the absurdity of standard options, he introduces the story of Fred Futile.
Fred Futile, CEO of the fictional company Stagnant Inc.
Yes. The math here is vital to follow. So Fred gets a standard 10-year option on 1% of the company's stock.
Okay.
Stagnant Inc. is a sizable company. It has a net worth of $10 billion, and it earns $1 billion a year. So that's $10 of earnings per share on 100 million outstanding shares.
Now, Fred is the CEO, so he controls the capital allocation. He decides to pay 0 dividends to the owners.
Not a cent.
Instead, he takes that entire $1 billion in earnings every single year, and he uses it to buy back the company's own stock in the open market.
Let's look at the result after a decade of this. Over those 10 years, the underlying business doesn't improve by a single dollar.
It still earns exactly $1 billion a year.
Right. The products haven't improved. The market share hasn't grown. It is entirely stagnant.
Hence the name.
Exactly. However, because Fred used all the shareholders' retained earnings to relentlessly buy back stock, the total number of shares outstanding drops dramatically.
Right, from 100 million down to roughly 38.7 million shares.
And this is where the math works. It's dark magic.
Yeah.
Because the total share count is now so much smaller, that same $1 billion in earnings is divided among fewer shares.
So the earnings per share skyrockets. It goes from $10 up to $25.80.
Yep, and if the stock market keeps valuing the company at the exact same multiple, say 10 times earnings, the stock price jumps 158%.
So Fred Feudal, a CEO who has achieved absolutely no actual business growth, who has merely treaded water for a decade, executes his 1% stock option.
And he walks away with $158 million.
It's insane. And the letters point out an even more astonishing reality. Even if Stagnant's overall earnings had actually declined by 20% over that decade, the sheer math of the share repurchases would still have netted Fred over $100 million.
He gets insanely rich just by withholding the owner's money and letting the clock tick.
Just by sitting there. During one of the annual meetings, Buffett uses an analogy that makes this feel incredibly tangible.
The apartment building one.
Yes. He says issuing 10% or 15% of your company in stock options over a decade is like buying an apartment building, taking on all the mortgage risk, paying for all the plumbing repairs. But the seller insists on keeping a 15% interest in the upside forever.
Which no real estate investor would ever agree to.
Never. Every time you reinvest your own rental income to improve the property and the property appreciates, a massive chunk of that new value gets siphoned off to the seller who took none of the risk.
It exposes a massive structural conflict of interest because CEOs understand this math implicitly.
Oh, they know exactly what they're doing.
They know that every dollar paid out in dividends to the actual owners reduces the amount of capital they have inside the company to juice the value of their options.
Therefore, the incentive structure heavily biases them against paying dividends.
Even when the business is mature and has absolutely no good internal uses for the capital, instead of returning the money, they will use the shareholders' money to buy back stock regardless of the price.
Or they'll fund mediocre acquisitions just to keep the capital under their control.
Exactly, because their options act as a one-way claim on that retained capital. It is an arrangement that pays off in capricious ways, entirely unrelated to a manager's personal business accomplishments.
So if standard executive compensation is basically a rigged casino and Wall Street fee structures encourage terrible acquisitions, how do you actually build a massive conglomerate that avoids these agency problems?
Well, this brings us to a major theme across all the transcripts: Berkshire's own decentralized operating model.
It is beautifully countercultural to everything we just discussed.
It truly is. In the 1994 annual meeting, and echoed consistently over the next 30 years, they described their management philosophy with a baseball analogy.
They look for .400 hitters, and then they just let them swing.
Right. Berkshire is incredibly centralized when it comes to capital allocation, meaning all the excess cash generated by the subsidiaries flows back to Buffett in Omaha to be invested.
But they are decentralized to the point of near abdication when it comes to actual daily operations.
And the most striking part of that operational decentralization is that there is absolutely no company-wide compensation plan. None.
In fact, in one of the annual meetings, they joked that they wouldn't dream of having a compensation consultant come in and screw up their system.
Because compensation is hyper-tailored to the specific economics of each individual business unit.
To illustrate how this works in practice, the shareholder letters detail the compensation of Ralph Shea, who ran a subsidiary called Scott Fetzer.
Yeah, Ralph was compensated strictly based on the operational results of Scott Fetzer and nothing else.
His pay had zero correlation to the overall stock price or performance of Berkshire Hathaway as a whole.
And the underlying logic is bulletproof. Think about it. Why should Ralph get a massive bonus if Scott Fetzer is struggling, just because the broader Berkshire stock happened to soar due to a great year in the insurance division?
Right. And conversely, if Ralph is hitting home runs at Scott Fetzer, improving margins and dominating his market, why should his family's financial outcome be penalized if the capital allocators in Omaha make a mistake with a completely different investment?
It brings us right back to the typist analogy. Pay the person for the typing, not the company's overall earnings per share.
If a manager is riding a macroeconomic tailwind that they didn't create, they shouldn't get a massive windfall.
And if they are fighting a brutal structural headwind in their industry, but performing brilliantly compared to competitors, their compensation should reflect that heroic effort.
And if we extrapolate this hyper-tailored approach, we uncover a massive secondary benefit that is often overlooked.
Oh, the internal politics?
Yes, this structure leads to the almost complete elimination of internal corporate politics.
Because compensation isn't tied to some arbitrary corporate ladder, and managers aren't fighting over a zero-sum bonus pool dictated by headquarters.
So they don't have to spend their time jockeying for favor with the CEO. There are no show-and-tell PowerPoint presentations in Omaha.
There are no headquarters budgets that have to be negotiated and approved.
There are no corporate-wide mission statements that everyone has to pretend to care about.
It's so refreshing. A manager at a relatively small Berkshire subsidiary can actually earn a larger absolute bonus than the manager of a massive subsidiary, simply because their specific performance against their specific metrics dictates it.
It strips away all the bureaucratic friction and leaves only the pure incentive to run the underlying business efficiently.
But, and this is a big but, we must acknowledge a critical vulnerability here.
Right.
This extreme level of trust and decentralization only functions if the managers aren't trying to game their specific unit's scorecard.
Which leads us to a darker part of the source material. Analyzing what happens when the broader corporate world starts manipulating the very accounting metrics they are judged on.
This is where the transcripts and letters show genuine anger, rather than just philosophical disagreement.
Yeah, in the shareholder letters, there's a concept discussed called son of Gresham.
Right, playing off Gresham's law.
Exactly. The original economic concept states that bad money drives out good money. Buffett coined son of Gresham to describe the idea that bad accounting drives out good accounting.
It is a profound observation regarding corporate decay. When a CEO rationalizes using accounting shenanigans to artificially boost their stock, often because those massive option packages we discussed depend on hitting a specific quarterly number, they will almost always justify it to themselves.
They'll tell their board, well, our competitors are doing it, and if we don't, Wall Street will punish our stock price.
And once that attitude takes hold, ethical misgivings just vanish and the infection spreads across the entire industry.
A prime example detailed extensively in the text is the use of the restructuring charge.
Also known in finance as big bath accounting.
Let's slow down and explain the mechanics of the big bath, because it sounds like a highly technical term, but it's actually a very simple psychological trick played on the market.
It really is. Wall Street analysts love smooth, predictable earnings. They reward companies that hit their quarterly profit targets to the penny, and they severely punish companies that miss expectations, even by a little bit.
So what is the incentive for the executive? Imagine a company is already having a terrible quarter. They know they're going to disappoint Wall Street.
Right.
The executives are now heavily incentivized to take a big bath to dump years of anticipated future expenses into that single, already ruined quarter.
To understand what that actually looks like on a spreadsheet, consider the levers an executive can pull. They might look at a warehouse of aging inventory and decide right now to write down its value by $50 million, claiming it's obsolete.
Or they might announce a future layoff and take a massive charge for the severance packages today.
Even though the cash won't actually leave the business for another year, they might write off the intangible value of a past acquisition.
Suddenly, instead of reporting a mild earnings miss, the company reports a catastrophic loss.
But here is the trick. The cynical logic is that Wall Street analysts will forgive that massive, terrible quarter.
They will literally strip that huge loss out of their valuation models, label it a one-time, non-recurring event, and just look past it.
And that is exactly why the executives do it. Because by taking all those future expenses today, that massive charge cleans up the balance sheet so thoroughly that the company is mathematically guaranteed to have abnormally low expenses for the next several years.
By taking the bath today, they have artificially lowered the bar,
making it incredibly easy to beat earnings expectations by a few cents every single quarter moving forward.
It is not an accurate reflection of the business at all. It is an accounting illusion specifically designed to trigger executive bonuses and prop up the stock price over the subsequent years.
And Charlie Munger's contempt for this kind of manipulation is just palpable in the annual meeting transcripts.
He specifically targeted the refusal of major corporations to treat those massive stock option packages as an actual expense on the income statement.
Right. For years, accounting rules allowed companies to issue millions of options without recording them as a cost, magically inflating their reported profits.
Munger called this mandated corporate accounting weak, corrupt, and contemptible.
His argument was rooted in basic logic. If stock options are such a wonderful, essential tool for compensation, why do they need to be hidden from the owners through false accounting?
He compared it to someone going into the taxi business and deciding to depreciate the value of their cars over 30 years just to make their current quarterly profits look better.
It's a complete fiction. Furthermore, the letters point out a broader societal cost. They argue that the business elite risk losing their credibility on important national issues when they aggressively lobby Congress to protect incredible, self-serving accounting loopholes that solely benefit their own personal wealth.
This deep skepticism of manipulated numbers leads to a stark, practical rule that Buffett dropped in one of the annual meetings.
I know exactly which one you mean.
He said, "We have never had any great investment results from companies whose accounting we regarded as suspect."
It operates as a hard exclusionary factor. If the accounting choices are designed to deceive the owners, the management team cannot be trusted.
No matter how wonderful the underlying business model appears to be. But I have to ask a question that naturally arises when you read about all this corporate dysfunction. If institutional investors, like the massive mutual funds and state pension funds, own 2/3 of the stock of these giant public companies, why don't they step in?
It's the million-dollar question.
They have the voting power. Why don't they force boards to fix these broken compensation plans and stop the accounting schemes?
It is the most frustrating part of the whole equation. They absolutely hold the voting power to change it, but the transcripts reveal that the system is gridlocked because the institutional managers suffer from their own massive incentive-caused biases.
Wait, really? How so?
Well, you see, the managers of these giant funds are inextricably part of the same Wall Street ecosystem. The texts note that institutional investors often spend endless hours focusing on the minutiae of corporate governance.
Like debating pointless rituals or board committee structures.
Right, things that don't actually affect long-term economic returns. Meanwhile, they completely ignore the massive wealth transfer happening through stock option dilution.
Why would they ignore the very thing stealing value from their funds?
Because the institutional fund managers themselves are often compensated based on the short-term appreciation of their portfolios relative to a benchmark.
Oh.
And right now, their portfolios are benefiting from the very same accounting illusions, stock buybacks, and hyped-up earnings that the CEOs are engineering.
So if a fund manager demands honest accounting, the stock price of their holdings might drop in the short term.
Which hurts the fund manager's own bonus.
That is wild.
Furthermore, the shareholder letters highlight the sheer hypocrisy in the fund management industry itself. Buffett gives an example of what happens when a mutual fund management company is acquired by another financial institution.
What happens?
Suddenly, the independent directors of the mutual fund, who are supposed to protect the everyday investors, will eagerly approve massive fee increases for the new management company.
Why?
Because the acquiring firm paid a huge premium for the acquisition, and they need to recoup that cost by siphoning higher fees from the fund's everyday shareholders.
Unbelievable.
Munger frequently refers to an ideal state called trustee capitalism, where managers genuinely feel an overriding moral obligation to act as fiduciaries. But the reality, as diagnosed in the letters, is that the current incentive structures overwhelmingly reward short-term wealth extraction over long-term stewardship.
It paints a deeply unsettling picture.
Yeah.
It's like the entire modern market is built on interlocking layers of misaligned incentives, where absolutely everyone is getting paid to look the other way.
It really is.
But we know it doesn't have to be that way because we have concrete examples of how Berkshire successfully structures incentives within its own massive ecosystem to drive long-term value.
Yes. Let's pivot to the solutions.
Let's look at a specific operating example. Let's look at Geico.
Geico is perhaps the most brilliant case study found in the shareholder letters regarding how to fix a broken incentive. To understand what Buffett did, you first have to understand why the economics of the auto insurance business are incredibly unique. Writing a new insurance policy is initially a money-losing proposition. You have massive upfront marketing costs to get the customer's attention. You have underwriting costs to evaluate their driving record, and administrative costs to set up the policy.
Therefore, acquiring a lot of new customers aggressively actually hurts your short-term quarterly profits.
Exactly. And before Berkshire took full control, the incentive structure at Geico was entirely standard. Managers were paid bonuses based on short-term profitability.
So They were essentially being penalized by their own bonus structure for aggressively writing new business.
Because those necessary upfront marketing costs dragged down the very metrics their paychecks relied on.
The incentive was perfectly misaligned with the long-term health and dominance of the business.
Right, because expanding the base of policyholders is massively beneficial over the long term, not just for the underwriting profit, but because of the float.
We should define float clearly for the listener. It is the premium money that customers pay up front, which the insurance company gets to hold and invest before it eventually has to be paid out in claims.
It is essentially free leverage for investing. So Buffett looked at GEICO and completely inverted the incentive structure.
What did he do?
He explicitly told the operating managers that the corporate headquarters in Omaha would foot the bill for the costs of acquiring new business.
Oh, wow.
Yeah. He tied the managers' bonuses directly to the percentage growth in the number of policyholders, provided the underwriting remained disciplined.
So he actively rewarded them for producing what looked like initially unprofitable new business on the income statement.
And then rewarded them additionally for holding down administrative costs on the seasoned older policies.
He paid for the exact behavior he wanted. Massive growth in the underlying economic engine, the float, rather than a dressed-up quarterly profit number.
Exactly.
And there's another fascinating operational tool they use internally across all their varied subsidiaries, which is discussed frequently in the annual meetings: the cost of capital charge.
This is a crucial mechanism for handling the retained earnings we discussed earlier.
What?
When subsidiary managers are allowed to keep the profits their specific business generates to fund factory expansions or buy smaller competitors, human nature often causes a dangerous psychological shift.
Because the manager didn't have to go hat in hand to a strict commercial bank to borrow that money, they start to view that retained capital as free money.
Yes. They treat it carelessly, investing it in projects that only yield a 2 or 3% return simply because they want to build a larger empire.
So to combat that empire-building instinct, what does Berkshire do? They charge their own subsidiaries a cost of capital, which was historically set around 15% on any earnings the subsidiary chooses to retain.
By sticking a hard 15% rate on that capital, they are forcing the subsidiary managers to feel the true economic cost of holding on to the owner's money.
The message from Omaha is incredibly clear. If you want to keep this profit to expand your business, you better be absolutely certain you can generate a return significantly higher than 15% on it.
Because if you can't, you shouldn't be expanding. You should send that cash back to Omaha, where Warren and Charlie will find a place in the market that can.
It brilliantly aligns the individual manager's internal investment decisions with the high opportunity cost of the broader conglomerate. It cures the free money illusion instantly because the math demands it.
It's so elegant.
Okay, we've covered a tremendous amount of ground. By looking at the massive successes like GEICO, the ingenious mechanisms like the cost of capital charge, and the disastrous fictions like Stagnant Inc., what are the practical lessons that you, the listener, can apply to your own investments or even how you evaluate the company you work for?
Well, the first major takeaway is recognizing what true shareholder alignment actually looks like in the wild.
And it does not come from complex 40-page options packages crafted by highly paid compensation consultants.
No, it doesn't. In the letters, there's a running joke about a fictional consulting firm called Ratchet, and Bingo.
I love that name. It perfectly captures why boards hire them. The board wants plausible deniability. They want to pay the CEO a fortune, but they don't want to take the blame from shareholders. So they hire the consultant, who pulls a list of slightly larger, higher-paying peer companies and tells the board, to be competitive, you must ratchet up the pay.
And the cycle continues upward forever. And because that system is designed to ratchet up pay regardless of performance, Munger points out the vastly superior old-fashioned system used by many Berkshire executives.
They simply buy Berkshire stock in the open market with their own cash.
If you want a manager to genuinely think and act like an owner, the simplest, most effective psychological hurdle is to have them actually write a check and become an owner.
When they use their own after-tax money to buy the stock, they accept the exact same downside risks and the exact same carrying costs as the everyday shareholders do.
And reading between the lines of these sources, there is a secondary, almost invisible incentive at play here: the power of reputation and corporate culture.
Yeah, the transcripts frequently reveal that many of the founders who sold their businesses to Berkshire were already independently wealthy. They received tens or hundreds of millions of dollars in the sale.
They don't need the salary.
No. So why do they stay? Why do they keep waking up at 6 a.m. to fight for market share?
They stay, and they work incredibly hard because they are treated as true, respected owners. They are motivated by the joy of accomplishment and the autonomy they are granted.
And that culture of stewardship is carefully, intentionally curated from the very top.
It really is. The shareholder letters occasionally describe the physical world headquarters in Omaha.
This is great.
At a time when the entire conglomerate was generating billions of dollars in profit, the annual rent for their headquarters was around $270,000.
For a massive conglomerate.
The entire historical investment in furniture, artwork, and the office lunchroom was about $300,000. In one letter, they quote Winston Churchill, "We shape our buildings, and afterwards our buildings shape us."
An imperial corporate palace, complete with executive dining rooms and private fleets of jets, inevitably induces imperious, disconnected behavior.
Exactly. A modest headquarters signals to every manager out in the field that every single dollar of the owner's money matters.
We shape our buildings, and afterwards our buildings shape us. It's such a profound concept. It applies to so much more than just real estate. It applies to the incentive structures you build around yourself, your team, and your family.
Absolutely.
And for you, the listener, navigating the market as an investor, this philosophy provides a brilliant clarifying lens for evaluating companies. If you are looking at a business and you realize you have to mentally deduct 10% of their reported earnings just to account for the hidden, relentless dilution of their executive stock options,
You are applying a true margin of safety.
you are forcing the underlying business to prove it is exceptional enough to overcome the massive drag of its own management's extractive compensation.
So to summarize the through line of all these decades of letters, transcripts, and operational decisions, Buffett and Munger view incentives not just as a financial tool for running a company, but as the deepest, most reliable explanation for human behavior across all domains.
Yeah.
Whether you are dealing with a reinsurance broker placing a catastrophic risk, an investment banker pitching a glamorous merger, a CEO executing a massive stock buyback, or an institutional fund manager voting on proxy statements analyzing how they are paid tells you exactly what they are going to do.
If the corporate accounting is corrupt, it is almost always because the underlying incentives demand corruption.
And if the capital is allocated wisely and efficiently, it is because the manager is truly eating their own cooking.
It really is the ultimate shortcut to understanding the complex machinery of the market. Cut through the noise, ignore the mission statements, and follow the reward structure.
It's that simple.
And we want to leave you with a final thought to mull over as you go about your week. We've spent this time talking about how Berkshire applies the concept of eating your own cooking to the business world, demanding that those who take the risks hold the downside.
Right.
But what if we applied that mental model to the rest of society? Imagine a world where every politician, every financial regulator, and every media figure had to carry 80% of the personal financial downside risk for the policies or predictions they confidently push onto the public.
Oh, wow.
How quickly would the world change, and how differently would decisions be made if absolutely everyone had to eat their own cooking?